Good afternoon. Thank you for joining us on our call today. We are going to be talking about overfunded, max-funded life insurance, where we use cash value life insurance as an income tax efficient strategy for the affluent, high net worth, and ultra high net worth marketplace. Today we're going to talk about, the overfunded life insurance is primarily an income tax efficient strategy. It's about minimizing income taxes and getting tax deferred growth and future tax-free non-reportable income later in life. So why would someone want to do that? We're going to discuss the current fiscal situation in our country, the current taxation policy in our country. Where do we think taxes are going? Are they going to go up? Talk about non-modified endowment life insurance. What is it? How does it work? What are the rules? Talk about non-reportable income. There's a big difference between tax-free income and non-reportable income, particularly when you go into, our clients are going into retirement or in the distribution phase of their wealth. We're talking about funding. How do you fund a policy? How do you take distributions? Who's the ideal profile? A recap of the benefits. And then, as always with C.O.R.E Group, we're going to show you and talk to you about the strategy, but when it comes to doing analysis for each individual client to make sure if this strategy is appropriate for them, we do analysis and we show the analysis and say, hey, you're going to be better off with this strategy versus doing something else. So what's the current fiscal situation in the United States? I updated these numbers on June 9th, so they're probably, the debt ones are probably a little low. The aggregate debt of the United States is 123.9% of GDP at $37.5 trillion. The United States has the third highest debt to GDP ratio in the G20 after Japan and Italy. Not great company. The deficit for 2025 estimated at 6.4% of GDP at 1.7 trillion. This year's deficit is by the end of the fiscal year is probably going to be closer to 1.8 trillion. These numbers are higher. The debt number and the deficit numbers are higher than they were during World War II, to put it in perspective. And we're supposedly at peace. The big beautiful bill that was passed, the extension of the tax cuts from 2017 that were extended, will add $3 to $4 trillion in debt over the next decade. Just that part of the current fiscal situation alone. It's also estimated over the next 75 years, the unfunded liability for Social Security exceeds $28 trillion and Medicare and Medicaid $53.1 trillion. Now, those seem like insurmountable numbers, and I'm not, I'm probably, the issue is that, our GDP in the United States is 30 to 31 trillion dollars. If it grows at 2% over the next 75 years, it'll be 141 trillion dollars 75 years from now. So, I mean, though 53 and 28 trillion are large numbers and no one's really doing anything about it, it's not impossible when people have a doomsday scenario saying we can't overcome, or how are we ever going to fix this? But right now, nobody's talking about fixing any of it. There isn't a single bill in front of Congress that's addressing the Social Security shortfall. Social Security in either 2020, 2033 or 2034, if they do nothing, benefits will be reduced between 23 and 26% across the board. It's just math. It's not, people can have an opinion about it. It's math. It's just a question of when, not if. And again, there is nothing being discussed in Washington about addressing Social Security. They tried to rein in some Medicare, Medicaid costs over the next decade, and you thought they were burning the house down. It's a very tough political problem. So what is our current taxation? Just so, to put it in perspective, our current effective tax rates are some of the lowest they've been since World War II. We have some of the highest deficits and some of the highest debt since World War II. We also have some of the lowest effective tax rates since World War II. But right now, federal income tax for single person making over 250,000 is 35%, and it's over 500,000 for married couples. Capital gains is 15% if you're between 48,000 and 533,000 of income as a single person, and 15% between 96,000 and 600,000 for married. There's a Medicaid net investment tax of 3.8% on incomes above 200,000 for a single or 250 for a couple. There is no personal exemption in 2025. I should take that line out. The personal exemption has been permanently repealed. They did double the standard deduction, but they have taken out personal exemptions. There's also an additional Medicaid tax of 0.9% at 200,000 and 250,000 of investment income. And the current Roth income limits is 150,000 for a single person and 236,000 for a married person. There's a narrow $10,000 window in both of those where it's phased out rapidly. So effectively, you're in the $150,000 range as a single person and the $240,000 range as a married couple. You can't fund a Roth IRA directly. Now you could fund a Roth 401k, take your 401k contributions and put it into a Roth. As a matter of fact, if you are in the makeup provision age where you can start putting more money in because of your age into your 401k and you make over, I don't know exactly what the threshold is. I think it's 180,000. You have to put your makeup provisions in the Roth portion of your 401k. You cannot put it in the deductible portion. But again, these are relatively speaking, these are very low effective tax rates. And as well, the brackets are very broad at these levels, broader than they've been, and they're all indexed for inflation. So very low tax revenue, very high debt. What does that say about the future? Where do taxes go from here? Now, my cutesy line is I haven't a clue. I dropped my teacup in the wishing well and haven't seen the future since. If you'd have told me 14 years ago that we'd have $30 million state tax exemption for a married couple, I wouldn't have guessed it. There's so many things that have changed in the tax code I've been in the business since 1993. I was revising a spreadsheet that I had done back in 2006. I had written a spreadsheet that would illustrate an installment sale to an intentionally defective grantor trust. The estate exemption at that time was $1 million, and the annual gift exclusion was $12,000. Now it's $19,000, and it's $15 million per person. But I don't know where taxes are going from here. But given the fiscal situation and where taxes are, relatively speaking, which way would you be betting? Which way would you bet your family's future? Which way would you hedge? Life insurance is a powerful tool to use leverage, tax-favored treatment, and private beneficial transactions to achieve your long-term desired outcomes. And when do you start? Yesterday is better than today, and today is better than tomorrow. The sooner you start, the better the outcome's going to be. So if you think taxes are going to be higher tomorrow versus today, do you fund a traditional IRA or do you fund a Roth IRA? Logic says that if you believe taxes tomorrow, when you're taking money out of your accounts, are going to be higher than what taxes are today, you should fund a Roth IRA. Pay the taxes now, never pay taxes on any of the gains in the future. If you could get an unlimited amount of funds into a Roth IRA, how much would you put in? Well, unicorns don't exist. As we said, there are limits. For the affluent market clients, they cannot directly fund traditional Roth IRAs. So there are options. Overfunded non-modified endowment cash value life insurance. It's important that it be a non-modified endowment contract, funded with after-tax dollars, cash values grow tax deferred, distributions can be taken out income tax-free. It's first in, first out accounting. It's the only asset available to your clients where they can get their basis out first, gains out second. So basis comes out tax-free, it's return of your basis. And then you can access the gains in these contracts via policy loans. And it's non-reportable income. And there's so many other attractive features to cash value life insurance. So it walks like a duck, it talks like a duck, and we have to call it life insurance. Now, when we're talking amongst ourselves, advisor to advisor, and we're in our meetings, we call it a super Roth IRA for the affluent. Now, we can never say that to the consumer. We can't say that, we can't go out and present it as this is a super Roth IRA for the consumer, but it is taxed. It's funded with after-tax dollars, tax deferred growth, tax-free distributions, non-reportable income. So what is it? What is non-modified endowment life insurance? So prior to 1982, you used to be able to put a single premium into a life insurance policy and never pay taxes on the money again. So what happened in the early 80s is brokerage firms like Merrill Lynch, as example, they were running full-page ads in the Wall Street Journal saying that one of the greatest tax shelters available of all time. So you could put in $100,000 into a life insurance policy at that time, buy $110,000 of insurance, which means you're only paying for $10,000 of insurance. And at that time, money market rates were paying 14, 15, 16% inside of these policies. And you'd never pay tax on that money again. So the IRS got a little agitated by that, and they went to Congress and said, we need to put some limits on this. So they came out with definitions. So you have modified endowment life insurance, which is typically thought of as a single pay policy or a policy that has way too much cash value in it relative to its face amount. And then you have non-modified endowment. And the IRS came up with definitions, guideline annual premium, guideline single premium, 7-pay TAMR premium. And some of those evolved in the 1986 Tax Act and have evolved over time. But they basically said, we need to put limits on this. We're going to put definitions in. And so then life insurance split between modified endowment contracts and non-modified endowment. A modified endowment life contract is taxed like an annuity. Gains come out first as ordinary income, and basis comes out last tax-free. So basically a modified endowment, while the owner insured is alive, it operates like an annuity, and at death it pays out like a life insurance death benefit, income tax-free. Non-modified endowment is what we're talking about here. So, and I always ask people, if the IRS is putting limits on something, are they doing that because it's good for you or good for them? Right? So why, the IRS says, we don't want you putting too much of a good thing into your 401k. We don't want you putting too much money into Roth IRAs. We don't want you having too many tax benefits. So we're going to put limits on it. So the IRS came out and they put limits on how much money you can put into a life policy and still have it qualified as a non-modified endowment contract with these Roth similar taxation characteristics. So I always say that to people, listen, if the IRS is trying to keep you out, trying to limit how much of this you can do, it's probably a good thing for you. So it's a tax optimized accumulation and distribution solution. It's tax deferred growth with tax-free income, and I keep stressing non-reportable income, and we'll talk about that a little more. It's Roth-like tax treatment. There are no IRS distribution guidelines to follow. So it's non-reportable income. And guys, this is black letter law. This is as 101 plain Jane planning as you can get. There is no opinion that this is black letter tax law. So it's the IRC section 7702, Revenue Ruling 74-500, IRC section 72ES, IRS section 72V. So tax exempt muni bonds are listed on Form 1040 line 8B, and it affects your modified adjusted gross income, right? So people say, oh, I get muni bonds, that's tax-free. Yes, but you still have to report it, and it still affects your modified adjusted gross income, which affects your Medicare, Social Security benefits, and there's many other things that your adjusted gross income will affect. And it will also affect some of your deduction limitations on how much you can deduct relative to your income. The distributions out of a life insurance policy are non-reportable income. So there's also asset in 37 states, the cash value of the life insurance policy and the death benefit are protected against the creditors of the owner of the policy. So there's many states that say the cash value of that life, as long as you're naming a natural person, in some states will say it's got to be an immediate family member, parents, siblings, children, grandparents. There's got to be some type of familiar relationship. It enjoys the same asset protection as pensions and homestead values on your home. So it is not subject to liability and tort. And in many states, the death benefit proceeds that are paid to the beneficiary are not subject to the beneficiary's liabilities and torts, which means that if they have creditors and they get a death benefit from their, I name my daughter beneficiary, my daughter gets that death benefit. They cannot attach that death benefit to satisfy their judgments against your daughter. Now, to really lock that down, you'd have it go into a trust, but that's a different conversation. So it's a self-completing plan in the event of premature death. If you're putting $10,000 a month away into a managed portfolio of ETFs, and at the end of 10 months, what do you have in there? $100,000 plus or minus market gain. If I put $10,000 a month into a variable universal life policy, and I go into the S&P 500, Vanguard S&P 500, and I put my money in there, at the end of 10 months, my cash value is going to be whatever the performance of the cash value is, plus or minus, but I'm going to have an income tax-free death benefit that is some multiple of what my contributions are. And that death benefit is always going to be greater than whatever you put in. So regardless of what the performance in the policy is, you're providing financial security, a self-completing program to achieve your long-term goals. If you don't make it to your long-term goals, those you care about will still get this income tax-free death benefit. It will self-fulfill the plan that you put in place for yourself for those you care about. They will receive income tax-free death benefit that is a many times multiple of what your contributions are going into the plan. So again, what's better than tax-free? Non-reportable. You don't have to disclose it to the IRS. It's off the radar. Why is that? So if you go to the bank, you want to buy a boat, and you don't want to take it out of your investment. So you're going to go to the bank, and you got money in CDs at the bank, and the bank says, you're such a great customer. We're going to give you a favorable interest rate on this boat loan. Well, they're not doing you any favors. They know they've got your assets, so it's 100% collateralized. If you default, they'll take your CDs, right? So they've got no risk. So they're going to give you $100,000. It's a small boat, okay? They're going to give you $100,000 in a loan. Do you have to put on your 1040 that year the fact that you got a loan from the bank for $100,000 to buy a boat? No. So when you take money, you borrow money out of your life insurance policy. Instead of it being a bank, it's an insurance company. They're loaning you money, the same methodology that a bank loans you money. And they're not going to say, oh, and by the way, you got to go report what we just gave you on your 1040. It's non-reportable income. It's black and white letter tax law. It is center of the court. I mean, this is so simple, right? You have people out there doing all kinds of crazy, aggressive things to shelter income taxes. And this is the simplest, plainest, down the middle of the road strategy they can do. It's simple. It's easy. And there's nothing to worry about. You get audited, you actually get your own life insurance. You have flexibility in managing future tax burdens, and it creates additional tax benefits. Again, you can control when you take money out of the policy. There is no 59.5 restriction. There's no penalty if you want to get it out before 59.5. There is no age 73 or age 75 where you have to start taking distributions. There's no one's telling you when you have to take the money out. No one's trying to penalize you if you take it out too soon. So you have the flexibility of managing cash flows. I got this pool of tax-free money over here, and I've got all these other options. This year, I need to minimize my taxes for whatever reason. Oh, let's go over to this pool and take that money out, and I'll keep the other stuff growing deferred. It provides another option and flexibility for income planning. It reduces taxation on Social Security. It can reduce taxation on other income. Why? By keeping you out of a higher tax bracket. It can help increase your deductions. It can minimize Medicare Part B premiums, and it can maximize total new after-tax dollars to spend. Again, having that flexibility of where you're taking money from can extend out the duration that you'll be able to take money out from all of your accounts. So what are some other features? And again, these features are pretty unique to life insurance. You're not going to get this in a managed account. You're not going to get this, in a portfolio of mutual funds. You're not going to get it in a stock portfolio. So one, relative to qualified plans, there's no 59 and a half early distribution penalties. There's no age, and I've got to raise that to 73 now, minimum distribution requirement, soon going to 75. You have flexibility of funding. Every time we illustrate this, we show this linear, $100,000 a year going in for 10 years. It doesn't have to be that way, right? There's flexibility. Now, when we solve for this in the structure, we'll talk about the structure. We're buying the least amount of insurance possible. We're putting in every premium dollar we can from day one and still maintain the tax favored status of that policy. So we're minimum face, maximum funding. If you're maximum funding, you're putting in much more money into that policy to sustain it long term, which gives you greater flexibility in the future. So, something happens in year 5, you have a business opportunity, like, you know what, I'm going to take that 100 grand and I'm going to invest it over here. You're going to be okay skipping year 5 and putting it in year 7 or year 6. Right? You have flexibility of funding. We show illustrations with linear funding, but it doesn't have to be that way. You have disability income riders. You can put disability, you become disabled. We have riders where they'll not only cover the cost of the policy, the COIs and admin costs. Some carriers have it where they will continue the scheduled funding, which means that they'll continue overfunding that policy. You have critical illness riders. You have a heart attack and you're incapacitated for 6 months, and so you have a critical illness. You can get accelerated death benefits, income tax free off the death benefit of the policy to help cover shortfalls. Chronic illness riders, you've developed some type of a chronic illness that's debilitating and you can't continue to work. There's riders that accelerate that death benefit. We have true long-term care riders. You qualify for 280Ls and you need assistance. You can start accelerating that death benefit to pay for long-term care expenses on an income tax-free basis. And terminal illness riders, you're diagnosed and you have less than 12 months to live. Some carriers, it's 24 months. You can accelerate the death benefit to help cover expenses through that challenging time. And again, bankruptcy and asset protection in 37 states. These are all great features of overfunded cash value life insurance. I mean, it's a great suite of benefits that people can contribute, that put savings away again, this is about money they're getting killed on income taxes, right? We're trying to shelter against future income tax liabilities, and we can get all these other benefits along the way. So what's the structure? First off, your client must need life insurance. That's a pretty broad statement. It's easier to define who doesn't need life insurance than who does. Who doesn't need life insurance? Somebody doesn't care about anybody else, right? Someone who they don't care about others. There's no one that they're looking to provide for in the future. They don't have a family. They don't have a community. They don't have a charity. They don't have a faith that they care about beyond themselves. They don't need life insurance. Pretty much everybody, if your clients have someone in their lives that they care about, that they're responsible for, that they want to make sure are okay, they got a need for life insurance. So it's maximum funded, minimum face. Again, the IRS defines where that limit is at any given age for a given face amount. They say this is the maximum you can put in and still maintain these tax favored benefits of the non-modified endowment policy. We go up to that limit when we're doing these things. And it's funny because the clients will say, hey, this is going great in year 5. And they're like, hey, I want to put more money in. Well, we got this thing pretty maxed out. You really can't. That's going to minimize the insurance relative to the cash value, which long term will minimize the cost of insurance. The overall drag on the policy starts once it's fully funded after the first 5 to 7 years and the cash accumulation hits critical mass. The drag of the cost of insurance and the admin fees on that policy long term are in the 0.9 to 1.2% range. That's the drag, right? And similar to what would be charged in a fee-based, asset-based fee account. We use an increasing face while funding. Why? Because the face is increasing, which means the death benefit's floating on top of the cash value. That means that we can get more money in sooner because of that increasing face, because we're buying a fixed amount of insurance that floats on the cash value, which means we can get more money into the policy sooner. And I can really geek out here and get into the technical aspects of the 7-pay premium and when it resets. It resets, generally speaking, every 5 to 7 years with an increasing face and every 10 to 12 years with a level face. This strategy is focused on cash accumulation. Again, this is an income tax play. We're not, because I get pushed by, well, this is inside of my estate. It's going to make my estate look bad. Why do I want to do that? And I'm like, well, if you're worried about that, then stop putting money in your 401k and start burning it, because your 401k, as it grows, is going to increase your estate too. We're just doing it more efficiently. It's not about estate. This is about income tax. And ideally, you're going to have a 10+ year on funding with distributions at 15+ years. I'd like to take a break here, and this is about cash value life insurance. The time horizons I like to talk to people about with this is time horizons similar to those of your retirement strategies, whether it's funding IRAs, 401ks, 403bs, whatever it may be. Your time horizons for this strategy should be in those durations. There are strategies out there right now that are called infinite banking and be your own bank, where they treat life insurance like silly putty. They put money in the first year, borrow it out the second, put more money in the second year, borrow that out the third, and they keep churning money through this policy with some belief that by doing so, the insurance company's paying you to borrow money from your own life insurance policy. I spend more time torpedoing those concepts. They're not good. Your client should walk away from those. Infinite banking, be your own banker. That's not what we're talking about. We're talking about long-term strategies. Now, that's not to say if you're 5 years into your funding and there's some acute situation arises and you say, hey, I need to tap into that. You can tap into it, with the expectation that you probably pay that back if you want the long-term benefits, right? This is not I'm going to pay premiums for 3 years and then I'm going to bail on this thing. No, because if you start funding, I don't care if it's max funded, however you do it, and you fund for 5 years and decide you want to surrender the policy, you might as well just run your $100 bills through a shredding machine, right? These things are typically loaded up front. There's a big difference between the cash value and the surrender value in the early policy years. This is not a short-term play. This is not short-term money. This is long-term money. How do you take distributions? We typically illustrate a withdrawal basis and then take loans from the cash value. Now, there are strategies where some people will show 100% loans. Why? Because they're using something called a variable loan. And the variable loan, assuming positive arbitrage, is going to show that the loan reserve account's actually kicking off positive feedback into the policy cash value, which it can when that arbitrage is positive. We always illustrate the fixed loans, because we're trying to under promise and over deliver. The variable loans always will show better than the fixed loans because they're always assuming positive arbitrage. The problem with variable loans is that there's going to be years, it's inevitable, where the loan reserve account's charging more than the policy cash value's crediting, and it can suck money out of the policy cash value too. So we show the withdrawal basis, then loans. All distributions will reduce the net death benefit, and you must retain some cash value in the policy, right? So there's many of the policies that we're showing, the accumulation policies, will have an overloan provision rider where if the policy cash value gets down to a certain percentage of the total value of what's going on in the policy, the overloan rider will kick in and it'll flip it to a paid up contract. You're not going to get any more money out of it, but the policy will also never lapse. And typically we show wash loans, which is the fixed loan strategy. There are variable loans. We just don't illustrate them. I'm not saying that when the time comes for your clients to take distribution, you shouldn't have a conversation about variable loans, and that it's a strategy and that it can work and it can enhance the value. We just don't show it. Again, our strategy is to under promise and over deliver. So who? Age 0 to 60, high income. Well, the 0-year-old's probably not making 250 a year. Typically, when you're seeing this, this is the grandparents or the parents setting up policies on kids putting $100 a month away. You'd be astounded at what the numbers look like. You start someone that's just been born and you put $100 a month away and you project it out to their age 65. Well, doesn't matter if Social Security's there or not. You've just basically replaced Social Security for your grandchild. Anyways, this is for the affluent, okay? People making over 250 a year, they don't qualify for Roth. You've got at least a 10-year time horizon for all the positive arbitrage going on with the taxes versus the cost of insurance and the expenses of the policy. You're already maximizing your qualified distributions. You take it, listen, we're not saying, hey, do this in substitution of a qualified plan. We think you should do qualified plans. That's one strategy, right? That's one tax strategy. This is in conjunction. This is for people, they've already maxed out all their 415 deduction limitations. And they're still got an income tax problem. I can't do anything about today, but I can certainly do something about every day after today, right? With a strategy like this. They're still getting hammered by income taxes. They need to be healthy or the spouse needs to be healthy. Why? Because this is life insurance and they have to be underwritten. Have a desire for asset protection. There's a lot of litigious professions out there, doctors, dentists, that need asset protection. This is a great strategy. Just from an asset protection, this is a great strategy. Overfunded cash value life. And business owners that have no qualified plan, or they're being limited out, they're being limited as the owner, being top hat in the plan, and what they can put into their qualified plans being dictated what the rank and file are doing in their qualified plans. So this is an option for them to say, hey, I'm going to do this over here for myself. So again, this is for the semi-affluent, affluent, high net worth, ultra high net worth. This is not, if someone's got $5,000 a year to put away and they're making $100,000 a year and they're 35 years old, we should buy them some term insurance and have them put the $5,000 in a Roth IRA, right? Let's get their max out the amount of death benefit that they have for their family's financial security and put the money in a Roth. So let's do a benefit recap. Life insurance, tax-free income, non-reportable income, known tax rate. You control the tax rate on your distributions because you can control your distributions. You have creditor protection. It does not impact Social Security benefits, Medicare premiums, adjusted gross income, and it's got a tax-free death benefit that provides financial security from day one for those you care about. A taxable investment does not have tax-free income, does not have non-reportable income. You don't know what your tax rate is going to be in a taxable account. How many times in your careers, just look at your own career, has income tax rates changed? Most taxable investments don't offer any credit protection. They will impact your AGI. They will impact your Social Security. They will impact your Medicare premium contributions. And they don't have any death benefit. What do something happens to you, that proverbial bus comes down the pipe 5 years into your strategy. In a taxable investment, those you care about are going to get what you put in plus or minus returns. In the life insurance, they get tax-free death benefit. So don't tell me, show me. So we run analysis on every client, right? So theoretically, this can work for people over 60. It's really about how many years you have to fund it and how long you have to defer it. And so we run analysis and we have people bring us cases, individual clients. So we'll do one, we'll say, let's run an analysis for your client. We'll run and we'll go out and we run every variable. Well, we run index, we run fixed. It's not just variable. I happen to have a preferential. I prefer variable universal life over any other cash value accumulation strategy out there. It's not my preference that matters, it's your clients. This works for whole life, this works for fixed universal life, this works for index universal life, right? All of those products. This strategy will work. It's about your client's risk tolerances, not mine. But I happen to think I'm bigoted towards variable universal life. So we'll optimize policy design given a desired funding amount. We run hypothetical taxable investment accounts. And these models we run, we've got turnover ratios. We've got long-term, short-term capital gains ratios. We can break it out by growth and dividend income. We can put qualified dividend tax rates in it. It's a sophisticated model. Most people that do these analysis, they're actually skewing it towards the life insurance because they're saying, okay, you're getting an 8% return, and they treat that 8% as ordinary income every single year. We don't do that. We use capital gains rates. We use turnover rates. We have long-term capital gain deferrals, which means we're enhancing or making the taxable investment account look better versus the variable universal life. We're giving the taxable side every benefit of the doubt. Right? We can run these things at 100% capital gains taxation with the right time horizons. The life insurance is still going to beat it. So again, our goal is not to jam a sale. Our goal is to say, hey, based on reasonable assumptions, here are your two options. And there's times where we'll come back and say, your client's probably better off in a tax efficient managed account versus an overfunded life insurance because of either the time horizons involved, or they're not, they're rated table 4. There's other issues involved that may not make the insurance the efficient vehicle that it can be most of the time. And we'll come back and say, hey, your client's better off going into a managed account, a taxable managed account. Again, give us an opportunity to run the analysis for your clients that are looking for tax efficient accumulation in their lives. It's plain Jane black letter law. It's down the, again, this is as simple and plain Jane as you can get. It is one of the most efficient tax planning strategies available to the affluent today. It doesn't require lawyers. It doesn't require opinion letters. I'm shocked when I present this to CPAs and it doesn't wow them, right? I'm like, what do I got to do? It's incredibly impactful and effective. Let us demonstrate that to you with your clients, your high net worth, your affluent, semi-affluent clients, and show that this is an efficient way for them to accumulate wealth. This is my statement. It's one of the greatest long-term financial planning strategies available to the affluent today. I used to have on there bar none, but I was told that was over the top. So non-modified endowment life insurance, right? Keep it in mind for your clients. We know what we're doing. We're going to go to the marketplace. We're going to show you every carrier we have access to when we're running the strategy, provide you that analysis, show you every carrier, provide you every illustration for every carrier in case you want to dive deeper into it. We're going to come back and make specific recommendations as to which carrier we think is best with all the other factors, underwriting, investment selection options. Does your client prefer passive indexing? Do they want active money management? Whatever they want, we're going to come back and say, okay, based on the criteria that we've got for this particular client, this would be our recommendation going forward. As far as technology, we've got many e-platforms to help you fulfill your opportunities. We handle the licensing and contracting. We get you appointed with the proper carriers. We make sure your continuing education is in order. We've got iGo, drop ticket, e-application resources. We pretty much every electronic format out there when it's possible. Now, I will say in much larger cases, when we're putting hundreds of thousands of dollars a year away into a life insurance policy, we still like ink on paper because it lets us retain much more control of the process. We've got jet issue, quick turnaround times, electronic premium payment options, e-policy delivery. Everything from submission to commission can be done without ink on paper and faster than ever before. Although, again, I will say, in the big cases, in the jumbo cases, we like paper because we can stay in front of everything. We can control everything and prevent little springs from popping out at the seams at the worst possible time. Because the insurance companies, they find a way to pop a spring at the worst possible time. So in some of these e-platforms, that can be an issue. But that's why we're here, C.O.R.E. We manage that for you. Most of the time, 99% of the time, if a spring pops out at a seam at the worst possible time, you never know it. Your client never knows it because we fix it. for you. So that's my presentation today. Hope you enjoyed it. If you'd like to have further conversations, you can reach out to your relationship manager. You can call in, ask for me, ask for case design team, and we're happy to provide illustrations, provide more information, whatever we can do to support you. Again, I think this is the greatest long-term financial planning strategy available to the affluent today, bar none. It's fantastic. It's right down the middle of the court. I hope you'll take advantage of the services and solutions we're providing. Thank you so much for joining us today. Have a great afternoon.
Hey, Rob.
Yep.
Someone, Nick asked a question, said simple until underwriting, question mark.
Well, we get in front of underwriting. If you think that there's a question about underwriting, let us get in front of it. Let us help you get in front of it. We have quick quote medical forms. You talk, pick up the phone, call us, talk to us. We've got one of the best underwriting teams in the country, right? We stay in front of things. We have underwriting resources. So if you think it's an issue, we'll get in front of it and find out if it's an issue before anybody takes the time to take apps. So yes, underwriting can be complicated. It throws a wrench in things at times. We're very good at preventing that from happening and wasting yours and your clients' time.